Most retail traders stack indicators thinking it gives them confluence. RSI says oversold, MACD says cross, Stochastic says oversold, CCI says oversold. For indicators agreeing must be a strong signal. The reality, all four of those indicators measure the same thing: momentum. They're calculated differently, but they're statistically correlated above 90%. When one says oversold, the others almost always say oversold. You don't have four confirmations, you have one signal echoed four times. Today, indicator multicollinearity, why most retail confluence stacks are fake, and how real confluence combines independent signal families instead of stacking variations of the same one. Here's the real confluence framework. There are four independent signal families: trend, moving average structure or higher high, higher low patterns; level, horizontal support and resistance from prior price or volume profile; momentum, RSI or MACD or stochastic. Pick one, not all of them; volume, expansion at the entry or absorption at the level. When you get one signal from each of these four families pointing the same direction, that's real confluence. They measure different things, so their agreement is independent confirmation. Stacking three momentum oscillators measures momentum three times. Stacking trend, level, momentum, and volume measures four different things. Watch this in a synthetic downtrend. RSI drops to 25, oversold. Stochastic drops to 15, oversold. CCI drops to -200, oversold. For indicators agreeing, a trader takes the long expecting reversal. Price continues lower. The confluence was an illusion. All four indicators were measuring the same persistent downtrend momentum. Their agreement told you only that momentum was bearish, not that a reversal was due. The trader needed evidence from other families: a level being defended, a trend structure breaking, volume confirming, not more of the same momentum reading. Here's the rule. Pick one momentum indicator and stick with it, usually RSI because it has the cleanest math. Then add a trend signal. Are we in an uptrend with higher highs and higher lows? Add a level. Is price at a structural support that's been defended before? Add a volume signal. Is participation expanding on the entry? For signals from four families, when they align, the alignment is real because each family is independent. The trade has actual confluence behind it, not statistical redundancy. Now the real confluence trade. Uptrend confirmed by higher highs and higher lows trend family. Price pulls back to a horizontal level that's defended three times level family. RSI clears 50 on the recovery momentum family. Volume expands on the trigger candle volume family. For independent confirmations, one from each family. The trader enters with high conviction. The trade has actual evidence behind it. This is what confluence is supposed to mean, and it's nothing like stacking three momentum oscillators that always say the same thing. On your own chart, audit your indicator stack. Categorize each one: RSI momentum, MACD momentum, stochastic momentum, CCI momentum. If four of your six indicators are momentum, you don't have a stack. You have one signal in four costumes. Replace three of them with a trend indicator, a level marker, and a volume tool. The same chart with independent signals will start producing radically different trade decisions and dramatically better win rates. So, stacking momentum indicators is multicollinearity, not confluence. Real confluence combines independent signal families: trend, level, momentum, volume. One from each agreeing in the same direction gives you four pieces of evidence instead of one piece repeated four times. Audit your stack and you'll find the fake confluence killing your win rate. Subscribe for the full method and trade your own plan. Education, not financial advice.